Hi, everybody. Welcome, everybody, to this webinar brought to you by Bursa Malaysia that is titled How to Avoid Value Traps in the Stock Market. All right. So, this webinar is brought to you by Bursa Malaysia and managed by our company, LifeChamp. This is Shen Chu. I'll be the moderator for these sessions. Today, we are going to talk about this exciting topic because it is value traps. Now, many of us here like to do bargain hunting. That means we want to go in to buy stocks on the cheap. But sometimes little do we realize that the cheap stocks that we buy turn out to be cheaper. Okay, so these are what we call value traps. So in in our quest to do value investing, sometimes we may bump into these value traps that is unknown to us. So today, our speaker will share with us how can we avoid all these value traps and emerge as a as a victor in this stock market. Now, before we begin, just want to talk about disclaimer. So whatever we share on this webinar is only for educational purpose. In no way that we give any buy or sell recommendation to any stocks that we cover. So in the event that we talk about any company, so we don't have any buy or sell recommendation. Okay, so if you decide to buy or sell anything, you do it at your own risk. All right, so allow me to introduce the speaker today. So he is a content producer of kclau.com. So we are very excited to have him here. He has written 100 plus articles on the kclau.com. He's also a regular webinar host and presenter. He is a co-founder of dividendvault.com, whereby he manufactured competent dividend investor who can build dividend paying stock portfolios in Malaysia, Singapore, and Hong Kong independently. So he himself is a dividend investor. He invests primarily for dividend income, and he got an average of 4 to 8% dividend yield every year. And he himself also has authored about 3 books. Okay, so Ian, welcome to our Bursa webinar.
Hey Shane, how are you? How's it going, guys? All
Yeah,
right.
excellent.
Yeah,
All right, so we are excited to have you in our Bursa webinar this year. So this is one of the last few sessions, so very glad that you're able to make it. All right, so I've just made you a presenter control. I've given you a presenter control.
yep, sure. I mean,
So
yeah,
take it away.
yeah, I'll take it away then. So first and foremost, thank you so much, Bursa Malaysia, and of course, Life Champ for having me here. Is of course a very exciting thing to actually be here to talk to you, to share with all of you, a little bit about my own investment journey. All right, um, as I as I actually journey along towards becoming financially free. Now, of course, this is actually the last episode of the webinar series by Live Champ for Bursa Malaysia, and therefore let's just end it with a bang. And I've actually prepared a lot of materials. So if it's possible, just please put your smartphone right beside you because we are going to do a little bit of calculation, all right? Because my webinar, right, every time I prepare slides, right, it's always not so complete one, because there's something always for you to do in my webinar. All right, so with that, let's move on. So in order to start this webinar, right, I have actually prepared a small game with you guys lah. So it's now game time, all right? So let's just play a game, and let's imagine us lah. Right now it's 2020, but let's just turn back time to year 2015. Okay, so now we are now at 2015, and I'm gonna give you two stocks where you can actually choose to invest. All right. So we have stock A and we have stock B. Okay. Now let's look at stock A. So stock A, the last year's dividends per share. All right. So it paid out dividends per share 21.5 cent, and you can actually buy it at 3 ringgit and 27 cents. So that's the stock price. So dividends per share 21.5 cents. Stock price is 3 ringgit and 27 cents. That is stock A. So perhaps you can actually calculate the dividend yields, and meanwhile, as you do that, I'm going to explain a little bit about stock B. So stock B is a stock whereby, now these are all actual stocks. So stock B, it paid out 11 cents in dividend per share. The stock price is actually $3.55. All right, so actually you can calculate the dividend yield for stock B as well. So I'm going to just give you maybe 1 minute or so to actually calculate the dividend yield. If let's say you do not know how to calculate the dividend yield, let me just share with you the formula. So it's very simple. You just take the amount of dividends, divide by the stock price, and multiply it by 100%. And therefore, there you get dividend yields. So Shane, perhaps we can do a poll with our 500 plus audience. All right. So let's just see.
Sure.
Be as honest as you can. All right. Which of the two stocks would you invest into? Is it stock A or is it stock B? So maybe we can let's see what's the response, and maybe from there we can see how or perhaps maybe you can actually, after you put in your stock A or stock B, right? Perhaps you can also type in what are the reasons for your decision. Why do you invest in stock A or why do you invest in stock B? Maybe you can Shane, maybe you can give us some feedback from the audience.
Sure. Yeah. So
Yep.
based on this information, decide which would you prefer to invest in, A or B. Okay. This just merely on dividend. Dividend factor, like you only have dividend as the sole decisions consideration. Now on my screen right now, I have got 99% of people say stock A because they have higher dividend yield at 6.57%, which is double
6.57%, huh?
which is double the dividend yield of stock B. So 99% of people pick stock A lah. I think there are a few pick stock B, but it is a small group of people.
Very small group. So apart from, okay, so 99% of the people actually will choose stock A because the dividend yield is 6.57%, right? And stock B, the dividend yield is 3.10%. So therefore, you will choose stock, right? Are there any other
Yes.
answers from I buy stock A because the dividend yield given to me is 6.57%. Are there any other funny kind of answers? Any unique kind of answers among the audience?
Um, I think this is the answer lah. Some say that some say that it is if we don't consider growth factor and other factor based on the available information is A lah.
Okay, so logically, I believe that most of us today here, all right, will actually pick on stock A instead of stock B. Now these are two real Bursa listed stocks. Okay, so logically speaking, based on this information alone, most people will actually pick on stock A over stock B. Now let's come back to 2020, whereby I'm going to review to you the results. Okay, the results for your investment. Okay, so I'm going to review to you, if let's say you invested in stock A, what will your results be like? And if you invest in stock B, what your investment returns will be like? Okay, so without further ado, I'm going to review to you the results. Okay, so let's say, for example, for most of you, like just now what Shane, my friend, has actually said, 99% of you have invested in stock A. So what happened is that you have purchased, the purchase price is actually 3.24, all right? So that is actually the purchase price that you actually paid for stock A. And over the past 5 years, as you can see, you kind of like get dividends, all right? So in 2016, you get 19 cents, 2017, 14 cents, 2018, you get 16 cents, 19, you get 16 cents, and 2020, you get 10.4 cents. So as you can see, if you want to compare it with the past, okay? So let's say, for example, okay, it seems like there's a typo, and this is where we are going to do a little bit of adjustment over here. So the dividends per share is actually 21.5 cents, okay? But here we can see that after 21.5 cents, right, the dividends per share is on the declining trend. All right, so that means to say your dividend yields on the per annum basis will actually drop, all right, will actually decline over time. And because of that, all right, so your dividend yields will actually drop on a per annum basis. But for the sake of calculating your total returns, which consists of dividend yields and capital gains, So your dividend, the total amount of dividends that you will receive is 75.4 cents. So if let's say I'm gonna just edit this to 3 ringgit and 27 cents. All right, so I'm gonna take your 5 years total dividend, which is 75.4 cents divided by 3.27. So what you will essentially get is actually, or should I just change? Yeah, I think I'll just change it to 3.24. All right, 3.24 is more accurate. So essentially, you will get in 5 years, the dividend yield is actually 23.3%. Okay, so this is the amount of dividends that you will get, but the stock price, it kind of like dropped. All right, it kind of like fallen from $3.24 and it kind of like dropped $2. For its capital gains and loss or losses, what you will experience, right, is a capital loss of 28.4%. So therefore, if we take your total dividend gains of 23.3% and we knock it off with 28.4%, so therefore your total returns from this investment is negative 1%. So this is what happens. So this is what happens if you actually invested in stock A. All right. And now let's look at stock B. So when it comes to stock B, right, here's what happens. So you have purchased it at $3.55, but as you can see, your initial dividends, right, but for stock B, after you invested, right, your dividends actually kind of like from 11 cents to 16 cents in 2016, 16 cents in 2017, 20 cents in 2018 and 2019, and finally in 2020, you have 23 cents. So in total, you will have 95 cents. You will have collected 95 cents from investing in stock B. And because of that, right, the total dividend gains in that 5 years period, right, is 26.8%. But what's more impressive is that um, if you actually look at capital gains and losses, the stock price at that time, after 5 years, it has actually reached $9.10. So your capital gains will be 156.3%. So in essence, after 6.8% plus 156.3%. So therefore, your 5 years total return is 183.1%, which is very, very impressive. Okay, so perhaps for those of you who are listening, right, maybe you're thinking, okay, let's see whether I can guess which are the two stocks that I have actually mentioned. All right, perhaps if you kind of like know, hey, I think I know which stock you're talking about. Maybe you can actually put it on the comment box. Maybe Shane, you can actually you can share with us the what do you call the feedback from the audience to see whether or not anybody gets it correctly, which stock I'm actually referring to.
Yeah, there are some names on my screen right now, but I wait for people who type finish lah.
No problem, no problem. Because I will give it another 1 more minute, and with that, let me just continue on. All right, so I'm going to talk a little bit about theory, and later maybe Shane, you can share with us who what are the possible stocks that people could have thought of when it comes to these two examples. Okay, I'm actually quite curious to know. So anyway, in essence, right, so this is actually a value trap. Of course, there are many ways to present this particular webinar, but from the dividend, but as a dividend investor, um, highlight, I would like to share with you guys, I would like to highlight with you guys value trap in the context of dividend investors. All right, because I'm a dividend investor. So a lot of people, when it comes to investing in dividends, right? So what they do is that they just invest in stocks, right? They just go to, they can use all kinds of websites. All right, it can be any, it can be like of course you can also use the Bersama Malaysia website. Of course, you can use Bersama Marketplace. Of course, you can use screeners or newspapers. Nothing wrong with using that. But today, I'm going to talk to you. I'm going to share a little bit about the wisdom on how you actually use all these tools so that you can actually make the use not go and find the ones that pay the highest dividends. So like some marketplace, they have a screener, right, where you can actually figure out like which of the stocks actually give the highest dividend, all right, because you want the dividend yield so much. So by using the screener, and then they will shortlist you all kinds of stocks that are paying you let's say of dividend yield. You just this one lah, because this stock pays you 7% or 8%, right? And people actually kind of like buy stocks because of that. That is
Ian,
actually not.
your
Yep.
Ian, your line is really breaking. So can you disable your video webcam?
Okay. So how about now?
Yeah, carry on. I mean,
All
your
right. So
voice is
it's
broken up
following me.
occasionally, periodically. So I guess it's safer for you to stream without the webcam.
Okay lah. Then I will just continue like that. All right. So let me just repeat,
Okay.
just in case most of you didn't get it. Some people actually use screeners. All right, and they screen out all the high dividend yield stocks. All right, and they see, oh, maybe certain stock is actually paying you 6, 7, 8% in dividend yield, and then you say, yes, this is the one lah. All right, this is the one I'm going to invest without doing any further research, and then they just go and buy stocks. All right, so most of the time, this is how people actually fall into value traps like this. They think that, hey, 8%, this stock, right, is giving you very good value, so therefore I think it's worth investing. Actually, that is not really the case, because for us as dividend, right, yes, we place a lot of emphasis on getting, want to consider a lot of other things, a lot of aspects, so that we can actually invest correctly into really good dividend stocks that pay you incremental dividends over time. All right, so that is actually very important. Okay, so which means we won't exactly like go and try to hit the highest dividend yield all the time, but we want to find companies whereby is cash flow very important here. All right, cash flow, because if the company doesn't have cash flow, right, then the company cannot expand, the company cannot invest into other things, and the company may not have the cash to actually pay you sustainable and incremental dividends. So cash flow very important here. All right, a lot of people neglected cash flow. So so this is actually a golden nugget by itself, which is to focus on cash flow and investing in the stock market. All right, and if let's say people don't focus on this, right, then it's very hard. Then of course a lot of people will fall into this value trap. Okay, now over here, right, just now it's a classic example how most of us, when we give you this kind of example, all right. Of course, I purposely go and come up with this kind of example, right, is to share with you that this is how it's actually an example on to illustrate how a lot of people actually fall into value traps that easily. Of course, just now actually when I talked to Shane, I actually wanted to find out, is there any smart aleck among the 500 people, right, who actually type in, a actually, Ian, you are not giving enough information. Maybe there are other factors to consider or something like that. So
Yeah.
I'm like,
There are people who type that. There are many people who type that.
there are many people who type that.
Quite now. Yeah, quite a few lah. Like if given available information, then they will pick A lah. But there are also people who type that cannot make a choice, because just dividend information alone cannot make up the choice lah.
Okay, correct. So I believe there are a lot of you, right? Of course, if I'm one of the participants, I will also go and put A lah. All right, but in the back of my mind, I say actually not enough information. Yeah, so for those of you who really thought, yeah, actually we need more information than just dividends, right? Yeah, congrats to you. You're actually getting the point. This is actually a way to actually avoid value traps. Okay, so Shane, I'm about to review to the world that the two stocks that I used for this case study. Is there any person who actually try to guess what are the
Yeah,
stocks
there
or
are
not?
probably 15 answers on my screen right now.
15 answers.
You,
So how about you
yeah,
share some of the answers before I actually continue?
yeah. Some people say stock B is Syntax, Hatta Lega, Top Glove, Supermax, Great Tech, Great Tech, Vitrox, Bursa, and some people are saying that it's Timecom, MPI, and some people say stock A is Astro, Berjaya, Toto, Genting, Malaysia. Yeah, so these are some
Okay, lah.
answer.
Okay, there are two stock A and stock B. There are some people who actually got it right, lah. All right. So I'm gonna review to the world what are these two stocks, lah. Okay. So stock A, right? Okay. So stock A is very simple, So those of you who tried, right, it's actually Berjaya Toto, lah. Okay. And stock B, all right, is actually Syntax. All right. So those of you who actually got it right, congratulations to you guys. You really, really nailed it, lah. You really got it correctly. Okay, so now I'm going to share with you how easy is it for you to avoid value traps. Okay, and for those of you, let's say for example, if you want to have a simple 10-minute test, okay, that means 10 minutes for you to actually identify, is this worth continuing on to study or not continuing on to study? How do you do this in 10 minutes? Okay, it's actually very simple. So now I'm going to turn back time to 2015. Okay, so turn back time to 2015, whereby you are given this kind of information. Okay, I'm going to start off with stock A, because stock A is about Berjaya Toto. So it's B Toto. And then stock B is Syntax. So I'm going to just type in here Syntax. Okay, so now let's say 2015, you're given this kind of information. So how do you go about it? The easiest way for you to go into it, right, is to look at is to go and refer to the Bursa Malaysia website. There's a lot of information inside here. Okay, but for those of you who do not know how to, because I'm actually a regular user, so I got this link already preset in my Google. But for those of you who do not, what you can do is that you can just go to Google and type in Bursa Malaysia. All right, straight away, right, just if you find company announcements, right, just click onto company announcements. It's the fastest way, lah. Then for the sake of time, or super accurate, I'm gonna just use the end report straight away. I'm gonna just type in Berjaya Toto, Berjaya Sports Toto. There's a lot of information here. Click search. Financial year end is a bit different between Berjaya Toto and Syntax. Berjaya Toto ends at April and Syntax ends at July. All right. So I'm actually this particular very easy. We're turning back time to 2015, so I'm just going to the 2015 and let it load. And as it loads, let me just also do the same for Syntax. Okay, so we have Berjaya Toto, right, 2015. So you just need to open up. Okay, so this is Berjaya Toto. The fastest way, all right, if you really want to save time, right, you look at this group financial summary. All right, they'll give you the summarized version of the financial statements. Just look at this. Profit attributable to owners of the parent. So this one is actually shareholders' earnings. Okay? And as you can see, it will give you, for Berjaya Toto, is very straightforward. It will give you 10 years worth of data. Like for example, 2015, it made 361.6 million. 2014, it made 328.7 million. 2013, 391. So all you need to do is just compile all these things, all right? And you compile it for the past 10 years, all right? So for me, I've done that. So as you can see, it's actually the bit, and I compile it all the way up to 2005. Okay. And likewise, for Syntax, you can also do the same. So you can also click onto the annual report here. You can open up the annual report. All this information are free, so you don't need to actually pay for stuff. But yet, not many people actually go and look at it. Okay. So what happened is that, of course, you can actually look at net profit growth, where it gives you the net profit 158,190, 148,450. So all you need to do is just compile the data. So you just compile it all the way back. So for me, I will compile it back to 10 years. So why 10 years? All right, why don't I look at the latest? Why is it that I will always use 10 years? Simply because, all right, for me, my perspective is this. Okay, as a dividend investor, I really want to build a portfolio which is sustainable. So what do I mean by sustainable? It means to say, in all economic condition, whether it's good times or bad times, all right, whether or not the ringgit is strong or whether the ringgit is weak, whichever whoever is running the country, whether it's the current administration or the opposition or whatsoever, whoever is, so it doesn't matter who is running the country, how strong is the ringgit, the strength of the oil price, because oil is really really important to Malaysia, to our economy, and it doesn't matter who is running USA, whether it's Trump or Biden, it doesn't matter who. All right, as long as in this 10 years period, right, I just want to know whether or not a company is able to consistently grow its profits over the past 10 years. So if a company can, despite all of this happen, and it still can actually continue to grow its profits, right? That means you say it has actually passed my sustainability test. So that is actually my take on building a resilient portfolio. Okay, and not many companies have the ability to do that. Okay, so look at Berjaya Toto. All right, so what you do is that you do here is this. All right, let me just here from once you have actually compiled the thing right, the next thing I like to do is that I like to plot a graph. All right, so I like to plot a graph like this. Okay, because for all my portfolio, like I love to for me, I will now explain the rationale behind me plotting a graph. Okay, so as you can see, this is Berjaya Toto's earnings results for the past 10 years. And see, can the highest at 2000.
Ian, are you still there? I cannot hear you at all. Ian, we cannot hear you at all. Is your line is really bad today?
Index. All right. So what you will do here is that I will also plot a graph. It's very simple. If you use Google spreadsheet, right, you can just plot a graph automatically like this. Now, if you look at Syntax, right, this is actually the kind of companies that I will be more than happy to actually spend some time to study and to find out what makes this company a success and whether or not is it a good time for me to actually invest. All right. So as you can see, for Syntax, it has actually from the graph here, it shows the company has consistently delivered growth in profits. So to me, in comparison, uh, between Berjaya Toto, which did not actually deliver any growth in profits, I would say Syntax will be a better bet in 2015. Okay, so that is the first way for me And this is actually, I won't say the first way, this will be a very trustworthy, it's actually a very, or at least to say, I would say it's trustworthy. I would say I will rely on this way to actually help me or to guide me to avoid myself from getting into value traps, all right, which is to look at the company's growth in terms of profits, all right. So the first method for me is to compile the shareholders earnings figure, plot a graph, and then the next thing that I would like to share with you is this, all right. I will actually explain how you can actually calculate CAGR. So CAGR is actually is an acronym for is an abbreviation for compound annual growth rate. Okay, so it is actually to measure the is actually to measure the growth rate of a company. All right, so in this case, we are looking at the company's growth rate in terms of earnings. All right, so here, how do we calculate? It's very simple. I'm going to show you a CAGR calculator. So I have it with me straight away on my Google. But of course, if you are not too sure, you can just type in CAGR, and you take the first one, which is this one, and you'll be given straight away the CAGR calculator. So this is a very handy tool where you can calculate the earnings growth of a company with this calculator. So let's start off with Wijaya Toto. So typically, if I look at this kind of graph, right, I won't actually calculate its CAGR because it's a little bit redundant because it doesn't show a consistency in terms of growth in profits. All right, but for the sake of illustrating how it works, right? So what you do is that you need to input three figures lah. The first one is the starting value, the second one is ending value, and then the third one is number of periods. Okay, so the starting value, right, is 2005, whereby it is 328156. So just put in 328156. The ending value is 2015, where it says 361610. So you just need to put in 361610. And then the number of period, right? The reason why I put, you see, actually, if you look at the spreadsheet, right, it says here, this is actually 11 counts, all right? But so why do I actually put in 11 figures? This is because for the CAGR calculator, for the number of periods, right, this is how it's calculated. Like you have a start year of 2005, right, which is 328,156. So this is your base year. So this is like year kosong or year zero. And then you have number of periods. So this is like after 1 year, 2 years, 3 years, 4, 5, 6, 7, 8, 9, 10. So this is like after 10 years. So therefore you can actually put in 10 years and then you calculate. So over here it says CAGR is 0.98%. Okay, so therefore you have it based on the calculator given. It measures the growth rate from here to here. The growth rate is just 0.98%, which I don't think is that for the case of Vijaya Toto, it's not so accurate lah, because it doesn't show a consistency of growth. Meanwhile, I would say it will be better. The CAGR calculator is better used for companies like Syntax. Okay, simply because it has actually demonstrated a period of consistency when it comes to its earnings growth. So if you use the same calculator, the starting year is 23118, so 23118. The ending value is actually 158190, so you just need to put in 158190. The number of years is also 10 years, so you just need to put in 10 years and just click onto the button here, calculate, and there you go, you have a CAGR of 21.21%. So which means over the past 10 years, right, Syntax has actually grown at a rate of 21.21% per annum when it comes to its shareholders' earnings from the period of 2005 to 2015. Okay, so this is how you use CAGR calculator. Of course, right, you have like 900 over companies. All right, so how to save that? do you select? How do you select good stocks that have actually compiled the shareholders' earnings for the past 10 years? Put in the CAGR, just calculate the CAGR. So you can do this for Syntax, you can do this for Ajinomoto, you can do this for Nestle, FNN, and so on and so forth. And then you can actually compare the CAGR for all these companies. Then you can pick and choose whichever companies that you are interested to invest into. It's that easy, all right? So now let me go back to my slides. So where were we? So to me, how do you actually, the question is this, the question that I would like to this answer is how to easily avoid value traps. Okay, so over here, just now, what I've shared with you is that why do we compile the 10 years financial results of the company? Why do we calculate the CAGR? Why do we plot the graph? It's simply because, all right, as dividend investors, as investors like in general, what we want to do is this. We are not thinking that this stock thing, right, is like Toto. It's not like a gambling game, you know. It's an investing game. And what makes sense for us, right, is that we treat stocks like as if we are investing into a business. All right. So instead of just looking at dividend yields, solely on dividend yields, what we like to do is that we will actually focus on the quality of the businesses. All right, we want to actually find out more about what the business does, how it performs when it comes to its finances, who is managing it, who is running it, and only then, once we like the business, once we say, hey, I think this let's say for example Syntax, I think this Syntax is a kind of company that I want to keep forever. Let's assume lah, all right. Then only we go and do the dividend yield calculation, the PE ratio calculation, and the PB ratio. So it's always the quality of the company first, then only we talk about the valuation. Not the valuation, then only come back and say, is this business the kind of business that I want to keep forever? All right. It's always the quality first, then only the what you call the valuation. Okay. So here's a simple list that I have prepared for you guys when it comes to avoiding value traps. All right, so you can see we have stock A, stock B. All right, so I'm gonna just quickly amend a little bit over here because it's not fair lah. First one is so from the graph, right, what we see here is that I put here decline lah. The 10-year profitability is on the decline, but yes, in terms of if let's say we take 2006 as a benchmark year lah, as a starting point, right? Because this is the highest profit ma. So it kind of like it kind of like declined. But if you go back to 2015, right, it kind of like in that 10 years period quite flat lah. So it depends on how you look at it lah. All right. So I'm gonna just put here flat or decline. Then to me it's not so cantik lah, not so nice. All right, because as dividend investors we want to actually invest for growth. But stock B, which is Syntax. Sorry, let's put this Syntax. For Syntax, right, the 10 years profitability is growing. So therefore Syntax will be preferred over Berjaya Toto, at least for me, if I'm back in 2015. When it comes to 10-year CAGR, here it's not much. I would say here it's not so meaningful. But Syntax, it has grown at a rate of 21.21%. And the thing is this. So this is just a simple test to see the CAGR for the company over the past 10 years. But these are all past results, okay? Now, if you look at Syntax, it has grown at a rate of 21.21%, right? So the question is this, all right? If you really, really want to keep this forever, and now you're at 2015, the question is this: how do you know that this company, right, is going to continue to grow its profits in the future? How do you know? Is it by speculation? Is it by guessing? Is it by trying to predict what will happen in the market? What will happen to the economy? The answer is not really the case. For me, as investors, right, it will be best to actually refer to the to the annual report, because the annual report itself will contain a lot of information about the company. You see, the thing is this: successful companies, right, always breed successful results. Always lah. It's like students. It's like school time lah. Like for example, those kids, right, with where if let's say their results are always they are getting A's in their results. Because why, they are always the type that studies hard and stuff like that. You can see that more or less, right, the students will continue to get A's throughout the entire year lah. All right, so that is the kind of companies lah or students that we want to invest in. All right. Instead, if you look at another student, sometimes there's another student whereby maybe his results, he gets C's, he gets D's, or he gets B's, but occasionally he gets an A. Does it automatically make him into a good student? The answer is not so lah. Why? Because the problem with him is maybe the A, right, just maybe it's out of luck. Maybe it just so happened that he studied during that period, so it actually performed well in that one particular exam. But it doesn't show a consistent results. It doesn't show consistency in his exam results. So these are the kind of students that we may not classify him as academically good students. So these are the companies that we may not want to invest into lah. All right. So I'm just using this analogy lah. All right. Hopefully you guys will understand. Okay. So for Syntax, yes, it is. But the question is, can it continue on with this kind of performance in the future? So in order to do that, usually, typically, right, all these companies are, if let's say they are still growing, they will love to tell you about their plans. All right. Because successful companies with tangible plans will love to tell you about their plans. So when they love to tell you about their plans, then it's up to us as investors to read all about it. Some companies, right, if they have a bleak outlook, or if they don't have any plan, usually they won't tell you in their annual report lah. Then from the investor's point of view, we can also say, oh, this company doesn't have much growth plan there. Do not know what it will do in the future. Maybe businesses is just going to be like just as usual lah. All right. So then we can actually make an assessment, our independent assessment on the company from the annual report. But if a company has a growth plan, they will be more than happy to actually tell you about it. Okay. So over here, you can see it's a lot of reading lah. But as you can see, I'm just going to point out a few lah, because I'm not going to go through the entire annual report with you. But suffice to say, right, the first thing that you want to look at is chairman statements, and you just need to pick up. You don't need to read the whole thing lah. All right, you just need to find stuff like this. Okay, you just need to find stuff like this. Like for example, on June 29, 2015, the group entered 2 sale and purchase agreements, all right, for the proposed acquisition of lands measuring 326.06 acres in Pulai, Johor for this one. And this one is actually to enlarge the group's land bank in Johor so that it can actually do property development. Okay, so that is in 2015. So these are actually growth plans, all right. So this is actually the kind of information that I want to tap, and I want to to know, to find out. So I say, oh, okay, this is what the management says, and this is what the management will be doing, all right, in the near future to actually grow its business. Okay, so I will actually put that down I will actually take this kind of thing and put it in my buku nota lah, all right. And another one is that we can find that, you see here, 5th August 2015, all right, it has actually entered into another share purchase agreement to acquire this amount of ordinary shares into Syntax Great Wall Ipoh Senyuan Berhad for $58 million. All right, so what does this Syntax Great Wall Ipoh Senyuan Berhad does? So it manufactures hygiene products, packaging, bakery bags, and form-filled seal bags with an international clientele base. Okay, so as you can see, actually, right, the skill set of the investor, right, is Very simple one. If you know how to read, right? If you know how to read and you take the initiative to read all these things, right? And you can exercise from there. You can actually make your own conclusion to the investment or to the company, right? I mean, that's it. All right, that is actually a very important skill set. All right, that an investor should have. Just by downloading the annual report, just read all this stuff and make a conclusion out of it. So there's no need for you to like go and speculate stuff and try to predict, try to outread or outbid the market in that way. Uh, for me, I think if you can read and you can find wealth of information from these places, right? Then I think you should do very well in stock investing. Okay, so you can compile all this kind of stuff. You can read about its growth strategies. All right, as you can see, there are a lot of stuff that is actually that they will try to actually tell you over here. All right, so you can read about it. So this is actually the first place. The second place, right, is after you read the chairman's statement, if you're even more virgin, right, you can read the review of operation. All right, so it's a lot of reading, I know, but here's the thing. Okay, this is outside the topic, but here's the thing. You are investing your money, right, your hard-earned money, into a certain company. So if it's hard-earned money, I think the attitude is more like for us as investors, right, to actually find out about the company as much as we can before we actually put our money into the company, because we are not gambling. We, as investors, we want to know as much as possible about the company. So I would encourage all of you to actually just take some time, study the annual report, just do a bit of reading, and from there you can make your own conclusion whether or not you want to participate. You want your money to participate in the company's growth or not. Okay. So all these things, right? I know it's a lot of talking over here, and but all these things, right, that I share with you, right, is actually part and parcel of the ways, right, that investors can do to actually avoid value traps. Many many of times people actually get into value traps is simply because they just look at a stock and say, oh, PE ratio very low, so they buy, or dividend yield very high, they just get into it. All right, but if you want to really avoid value traps, right, you just need to uh, go in deeper into the company, find out about its growth prospects, find out its past financial results first, find out its growth prospects second, and after you find out these two, ask yourself the third question, which is, do you want to keep this company for life? If the answer is yes, then move on to valuation. And if the valuation is okay, you can accept the valuation at that price, good, then the investment is yours. But otherwise, you move on. Why? Because in Malaysia, we got like 900 over companies listed. If this company is not for you, there's 899 other companies for you to choose. You don't need to like just uh, just focus on that one company alone. There's a lot of choices in Malaysia, all right? And of course, I'm not too sure whether Bursa will allow me to say this, but actually, because these days the world is actually quite globalized, right? It's not just Malaysia have 900. You can move into other countries like Singapore, US, Hong Kong, China, wherever, because it's now a globalized world. So there are many choices. You just need to pick one that is really the one that you like and just go for it. All right. So over here, back to the slides. I know it's kind of like long-winded for me here, but over here, right, I have actually summarized to you some of the growth strategies that Scientex have when it comes to this. But when it comes to Berjaya Toto, right, I put here nothing much. It's simply because there's not much of a. Okay, I'm going to show you Berjaya Toto. Okay, so this is Berjaya Toto, right? So all you need to do is just look at management discussion and analysis. So over here, right, you can look at the prospect. You see, all right, it says here you don't need to like go and speculate. It's just here. It says no major capital investment was incurred. All right, I say with rising costs weighing down on domestic consumer spending, and we have GST implementing with effect from 1st April 2015. The directors expect that the business will be challenging. However, it expect to maintain its market share. That's it. There's no real. Then you'll be thinking, okay, what will the company do to actually increase its dividends? Well, there's no plan, right? Because it's not even listed. It's not even stated in the annual report. So therefore, there's nothing lah. Okay. And if you read further down, so this is actually their businesses in the Philippines. Capital investment, it says there was no major capital investment, all right, except for HR Owen's acquisition of luxury cars. And well, that's about it. Okay, that's about it. So therefore, if you look at my slides, as you can see, this is what I've gathered from the annual report. What's the growth plan of Berjaya Toto? Nothing much. What's the growth plan of Syntex? A lot. Okay, then from here you can actually choose to answer this question. Do you want to keep this stock forever? Then this is a very personal question. You can say yes, you can say no. All right. If you say yes, put this in the watch list. Don't buy first. Okay. If no, then you just get rid of the company from your watch list. That's about it. And in your watch list of companies that you like to keep, right, then do the valuation, do the dividend yields, the PE ratio, the PB ratio, and stuff like that. And once the price is right, just be happy and you have the peace of mind to go for it, go for it. All right, it's that simple. And with that, I have actually answered it. I believe that I have shared as much as I possibly can about this topic on value traps, and this is actually from the context of a dividend investor. So I thank you so much. Thank you so much for your undivided attention, and I believe you have a lot of questions. So please do ask me all the questions. I believe I'll be more than happy to be here to answer each and every single one of them. So with that, I'm going to pass back the control to Shane. So Shane, I'm done.
All right, thank you so much, Ian, for your sharing on how to avoid value trap in the stock market.